Assalamualaikum and hi, my name is Muhammad Ismail, metric number 264159. So today my group will be presenting on the topic capital allowance. So there are 8 key points in total that will be explained by my teammate later on. So let me start with the introduction. So a person engaged in business activity will normally use assets in the course of producing business income. Therefore, depreciation provision is made in the accounts to reflect the true profits of the business. However, accounting depreciation is not recognized as tax-deductible expenditure by the tax laws simply because it really represents the writing off of a portion of the capital cost of assets over time. The taxpayer is granted a tax depreciation or capital allowance on qualifying expenditure incurred on assets for the purpose of determining the taxable income of business. Capital allowance are given only in respect of a business source and only for the person who incurs the qualifying capital expenditure. It is computed for a year of assessment and are deducted from the adjusted income of the business in arriving at statutory income. And it is also provided for plant and machinery only. So I will pass to the next presenter to continue with the main subtopic.
Assalamualaikum, my name is Aina Shahira binti Ismail. My metric number is 261098. Now I will talk about plant and machinery. So the plant and machinery are not defined in the Income Tax Act. However, the guidance can be obtained from judgments stated in case law in determining whether an asset is a plant and machinery eligible for claiming capital allowances under Schedule 3 of the ITA. So now, what is the real definitions of plant and machinery itself? A plant is whatever equipment that used by a person for carrying on his business but does not include in the stock trade. Meanwhile, machinery is actually a machine that has moving part and it's generally machinery easily to be determined compared to the plant. Now, I will talk about the cases that related with capital allowance of plant and machinery. So, at the first cases is Yamaha versus France 1887. So, the fact in this case is the plaintiff was employed by the defendant to drive carts. He objected that the horse had a vicious nature, but was obligated to drive it in any event. So, the horse kicked him. This held for the purpose of Act 1880 Act. The plaintiff was an employee. The horse was plant in the employer's business and its character was a defect in that plant. So plant include whatever apparatus or instruments are used by a businessman in carrying on his business. So the employer was liable in negligence. Next is Monvi versus Furlong in 1977. In this case, it concerns a lawyer's library. It can be divided into 3 parts. So the first is when a young man starts at the bar, he may, if he has enough money, buy a set of law report that is can be included as a capital expenditure. And then the second one is he may buy the textbook. They have a life of 4 to 9 years. That is also a capital expenditure. But the third is he may take in the periodical such as weekly law reports and the All England law report, but he needs to pay for them an annual subscription, so that is not a capital expenditure, it is revenue expenditure. So he can deduct the whole of this annual subscription from his income for tax purposes. So the help in this case is whether the first 2 parts of lawyer's library, which are certainly capital expenditure, are also plant. If they are plant, he can get a capital allowance in respect of the amount which he can deduct from his tax. But if it is not a plant, then he cannot claim that. The next case, for the third case, is Benson versus the Yam Art Club Limited in 1979. So the fact is, in Benson versus the Yard Arm Club Limited, the company claimed that the plant and machinery allowances on an old ship that was adapted for use as a floating restaurant. The ship was the structure within which the restaurant trade was carried on rather than apparatus with which it was carried on. So in this case, it held the Court of Appeal, Templeman LG said that she could see no distinction between a restaurant and the Tim's and a fish and chip shop in Bethnal Green, so both act as premises in which the trade is carried on. Next is Hinton HM Inspector of Taxes versus Madden and Ireland Limited. So the respondent company carried on the businesses of shoes and slipper manufacturer. It issues machine which could only function when furnished with knife or last appropriate to the particular process. The knife and the last were useless without the machines, so many thousands of them were in use and their life was short. A physical stock taking being impossible owing to the large number, so the company charged expenditure on new knife and last to capital and charged again profits 1/4 of the total cost in each of 4 succeeding half-yearly account. So in this case, it held the company claimed that this expenditure qualified for an investment allowances on the ground that the knife and the last were plant and machinery as well as being implement or utensils, and that the expenditure was on capital account. So for the Crown, it was contended that the expenditure was on revenue account and that the knife and last were not plant or machinery. So the special commissioner found that the knife and the last were machinery or plant and held the company was entitled to the allowances. Next is Gerald versus John Good and Sons Limited. So the fact in this case is the commissioner found as a fact that as a matter of commercial necessity, the partitions had to possess mobility and flexibility for that day-to-day running of the business. So they were therefore apparatus with which the company carried on its business. So in this case, it held that movable partition will help to be the plant. So the partition were part of the setting but were not part of the premises in which the trade was carried on. Last but not least of the cases is Rose versus Champer Sound Company. So the fact of this case is the plaintiff, the Rose, appealed the district court's order granting summary judgment to the defendant, which is Champer Soap Company, based on the court determination that Rose had failed to present evidence of discrimination on the basis of disability. So issued of material fact on 3 points. First is that Rose was not disabled within the meaning of the act, and then the second one is the Champer Soap did not regard Rose as disabled within the meaning of the act, and that Rose did not present direct evidence of discriminations on the basis of disability. So in this case, it held Rose has presented sufficient evidence concerning his claim that the company regarded him as a person with a disability. Perhaps the piece of evidence most indicative of this fact is the back case memo. So finally, the district court held that the memo could not be considered direct evidence of discriminations in Rose terminations, and it was made after Canberra placed Rose on provisions. Next, my group member will explain more about the cases that related to the capital allowance of plant and machinery.
Thank you, Aina. I'll continue with another case, which is Commissioner of Inland Revenue versus Barclay Curl and Corporate Limited. So this case about a shipbuilding and repair company built a dry dock along the banks of the Clyde River. The dock was designed to receive a ship from the river and to keep it in the dock, where the ship would be pumped into the water to expose the lower part of the ship for repairs and maintenance. After the repairs are carried out, water will be pumped into the dock to refloat the ship into the sea. It was held that the whole expenditure qualified as planned since the dry dock had the active function of removing a ship from the river, holding it upright while it was being repaired and returning it to the river when repairs were complete. However, the previous case has overruled the judgment in the case of Margaret versus Lowestoft Water & Co. So the water tower was used to store water, but its purpose was to increase pressure. Storage is a premise-like function rather than a plant-like function. It was indicated that a plant-like function does not necessarily make premise plant in circumstances where the premises also function as premise. So Finley J. rightly held that a water tower whose sole function was to produce water under pressure, and which replaced plant or machinery whose sole function was to do the same thing, did not thereby become a plant. Next is the case of J. Lyons and Corporate Limited versus Attorney General. So the War Damage Act 1943 gave compensation for damage to land and defined land as including buildings or plant. In this case, the company claimed that the some lands that were destroyed by enemy action were plant and so qualified for compensation under the War Damage Act. The lands were not part of the building, and the question was therefore whether or not they were plant. So the judge Utswat J rejected the claim. He decided that the lands were not plant because they were part of the general setting in which the business was carried on and were therefore not apparatus with which the business was carried on. Another case in CIR versus Scottish and Newcastle Breweries Limited. The company spent money on light fittings and wiring and decorative items such as wall plugs, tapestries, mural, prints and sculptures. The Special Commissioner found that the electric wiring was part of the fabric of the building. They found that everything else was plant. Also, the light fittings and decorative items satisfied the functional test required of plant, despite the fact that they form part of the setting within which the trade was carried on. So Lord Lowry held something which becomes part of the premise, instead of merely embellishing them, is not a plant. The items on which capital allowance had been claimed were part of the setting, hence the light fittings and other decorative items helped to be a plant. So what about a case in British House Reigate Hill Limited versus Hinder? Appellant stated that the pipes clearly perform a plant-like function by assisting in the transfer of water from the various water intakes to the main reservoir. They are not a normal part of the setting in which the appellant carries on its trade. Lord Denning held that the sewage pipes lead to carry away effluent from a restaurant were not plant. They are an essential ancillary to the house itself, just as much as the chimney stack. Come to the Cook and Beach Station Caravans Limited. The company operated a caravan park with leisure facilities including a swimming pool equipped with an elaborate system for filtering, chlorinating and heating the water. The company claimed as planned the cost of excavating, lining and concreting the pool and laying an area surrounding the pool, as well as the pumping and filtering plant itself. Chancery Division held that the whole structure was expenditure on plant and machinery. The pool was considered not on its own but in relation to the business carried on. Together with this case, Schofield vs. R&H Hall Limited, the taxpayer company contended that the silos as a whole, and not merely the machinery within, qualified for capital allowance as plant used in its trade. For the Crown, it was contended that the silos were part of the setting in which the trade was carried on and were not plant. The Special Commissioner found inter alia that the silos form an essential part of the overall trade activity. Their separate function being to hold grain in a position from which it could be conveniently discharged in varying quantities to customers. So the dockside concrete silos of a grain importer will help to be planned as they were not merely used for storing grain, but had the main function of holding the grain in a position from which it could be conveniently discharged to its purchaser. And the last one from me is about St. John's School vs. Ward. The school claimed Performance Measurement Association, or PMA, on a prefabricated gymnasium and laboratory. The capital allowance claim was rejected, all that the gymnasium and laboratory did was provide housing in which the school activities could be carried on. They were not apparatus with which the school's activity were carried on. The prefabricated laboratory and gymnasium were held not to be planned, as they were buildings and their functions were simply to shelter those who gave and received education inside it. So that's all for me. I will pass to Haris to continue. Thank you.
Assalamualaikum warahmatullahi wabarakatuh and good afternoon. My name is Haris Akmal, metric number 264487. So I will continue present the case under 1.0, Plant and Machinery. First case, Dixon v. Fitch Garage Limited. The company was operating a petrol filling station. The service area of the filling station was protected by a metal canopy, so the company want to claim capital allowance on that canopy. The claim was not allowed. The functional test was applied in this case This test looks at the function of the item in dispute and asks whether it has a functional purpose that enables the business performance. Functional test is whether the canopy had a functional purpose to enable the taxpayer company to perform the activity of supplying petrol to motor vehicle. So does the canopy help to supply petrol, or it is merely part of the setting where petrol is supplied? It was held that the canopy was not planned as it was not part of the apparatus supplying petrol and did not perform a function of carrying on the trade. Next, ZF the Comptroller of Income Tax. In this case, to determine whether that portable and demountable dormitories used for the provision of accommodation for workers employed are planned or not. The court applied both functional test and premise test in this case. The dormitories passed the functional test as it was commercially sensible as the sublease was short and could be terminated anytime. Nevertheless, the court held that the taxpayer failed the premise test as the dormitories only serve to provide accommodation to workers, and this is typical function of a premise. It was held not to be an apparatus with which the taxpayer carry on the business. The High Court held that portable and demountable dormitories are not planned. For cases between Wimpy International Limited v. Warland and Associated Restaurant Limited, both companies were affected by increasing competition from similar chains. They decided that the premise should be improved and redesigned to reach a wider market. To that end, such items as replacement shopfront, floor and wall tiles, murals, lighting, heater tanks, staircase, and raised floor. They claimed plant and machinery allowance on the items. In this judgment, the Inspector of Tax disallowed the claims as expenditure on the provision of plant and machinery for the purpose of trade. In concluding the case, Hoffman J. said that there were 3 tests to determine whether an item was planned or not. First, it must not form part of the stock in trade. Second, it must not form part of the business premise or business premise. Third, it must be used for the carrying on the business. Next, Comptroller of Income Tax v. Taj Mahal Hotel. The Supreme Court of India decided that sanitary and pipeline fitting in a hotel were part of plan and not merely a setting for the purpose of carrying on its hotel business. Next, International Limited versus Commissioner of Inland Revenue. A Limited provided leisure facilities, in particular synthetic 5-a-side football pitch. In constructing such pitch, the company incurred capital expenditure on excavation, infilling, draining, and sand-filled synthetic grass carpet. The carpet lasted for between 5 to 9 years. A Limited claimed capital allowance on the expenditure. The CIR disallowed the claim because the football pitch is not a plant. Next, cases between Ketua Pengarah Hasil Dalam Negeri v. Tropiland Sendirian Berhad. So the issue is whether the multi-story car park built by the taxpayer is a plant for the purpose of claiming capital allowance. The fact of the case, the taxpayer had agreed to lease a piece of land from the government. According to the terms of the lease agreement, the taxpayer would erect a multi-story car park on the land. The agreement also provided that the taxpayer shall build in accordance to the plans, elevation and specification as stipulated in the agreement. The taxpayer incurred capital expenditure on the construction of the car park and operated it as a car park for the users and occupiers for Complex Tun Abdul Razak. The Court of Appeal held that the purpose-built multi-story car park is planned after considering the peculiarity of the facts and the nature of the taxpayer service. The multi-story car park building was regarded as a tool of the taxpayers' trade rather than a mere setting. Hence, the multi-story car park was held to be a capital expenditure qualifying for Schedule 3 allowance. Next, cases between Ketua Pengarah Hasil Dalam Negeri VMSDC Sdn Berhad. The taxpayer was in the business of running a driving school for learners of motorcars, motorcycles and lorries. The taxpayer incurred expenditure in constructing a training ground and buildings for the business. The taxpayer claimed capital allowance in respect of the buildings and the training ground as qualifying building expenditure. The Special Commissioner of Income Tax (SCIT) agreed that the buildings are part of the setting because has no function to perform other than to shelter the trainees. The buildings did not qualify as planned. For training ground, it was prepared specially for carrying out the business and it played an essential part in the business and also satisfied the functional test as an apparatus used in the conduct of the activities of the trade. Thus, it constitutes qualifying plant and is eligible for capital allowance. On appeal to the High Court by the DG, the judge upheld the decision of the SCIT and pointed out the training ground, which is specially prepared for carrying out the business of a driving institute, is in fact an integral part of the taxpayer business and is therefore a plant. It is obvious that without the training ground, the taxpayer would not be able to carry on their business of a driving institute. That's all from me. Thank you.
Hi, my name is Saswini Satyamurthy, matrix number 264779, and now I'm going to talk about the initial allowance. Initial allowance is given for the first basis year of the relevant year of assessment in which the qualifying capital expenditure was incurred. The applicable rate is 20%, and no initial allowance will be available if the claimant was not the owner of the asset and the asset was not in use for the purpose of the business. The DGIR is empowered to permit initial allowance at any other rate. For example, an initial allowance of 60% of the qualifying capital expenditure is given if the plant and machinery is used in the working of a mine or the extraction of timber from a forest or other prescribed activities. However, a taxpayer can elect in writing to have the allowance limited to 20% of the expenditure. In initial allowance of 30% is given on qualifying capital expenditure on plant and machinery used directly on the construction of any works, roads, structure and buildings. The initial allowance and annual allowance rate is respect of imported heavy machinery used in the building and construction, mining and timber industries are 10%. Now we are going to see about the annual allowance. The annual allowance commences in a basis year of relevant year of assessment in which an qualifying capital expenditure is incurred and will continue to be given in the following and subsequent years of assessment until the qualifying expenditure is fully written off or when the plant or machinery is sold. Annual allowance is granted under the following circumstances, which are: A. Qualifying expenditure on plant and machinery has been incurred. B. At the need of the basis period for the year of assessment, the claimant was the owner of the asset. C. The asset was used for the purpose of the business at the end of the period for the year of assessment. Now we are going to see the rates of annual allowance for each type of asset. First, for heavy machinery and motor vehicles, the rate of annual allowance is 20% and the number of years for full cost recovery is 4 years. For plant and machinery, the rate of annual allowance is 40% and the number of years for full cost recovery is 6 years. And finally, others, which are office equipment, furniture and fittings. The rate of annual allowance is 10% and the number of years for full cost recovery is 8 years. Qualifying expenditure. Expenditure incurred on the installation of machinery or plant is also qualifying expenditure. Likewise, expenditure incurred on the alteration of an existing building or structure for the installing plant or machinery will be treated as qualifying expenditure and form part of cost of the plant and machinery subject to certain rules. A. 10% rule. Qualifying expenditure includes expenditure incurred on preparing, cutting, tunneling, or leveling land to prepare a site for the installation of plant or machinery. Such installation expenditure exceeds 10% of the aggregate of the cost of installation and cost of plant. Such expenditure will not qualify as plant expenditure. B. Fish pond, animal pens, and extra. Qualifying expenditure includes expenses incurred on fish ponds, animal pens, chicken coops, cages, building, and other structural improvements on land which are used for the purpose of poultry farms, animal farms, inland fishing industry, or other agriculture or pastoral pursuits. C. Qualifying expenditure for motor vehicles. The qualifying expenditure for motor cars not licensed for commercial use is Rm 100,000 on condition that the motor vehicle is new and the total cost when the new does not exceed Rm 150,000. The type of vehicle that not subject to the limitation of Rm 50,000 or Rm 100,000 are motor vehicles licensed or permitted by the appropriate authority for commercial transportation of passengers such as lorries, trucks, buses, minibuses, vans, station wagons, taxi cabs, or hire cars. D. 75% rule. The cost of preparing a site for the installation of plant and machinery exceeds 75% of the aggregate cost of plant and machinery and the installation cost, then the entire expenditure is treated as building expenditure on which industrial building allowances may be claimed. And finally, E. Date qualifying expenditure is incurred. Paragraph 55, Schedule 3, Initial Tax Act 1967 stipulates that the expenditure on plant and machinery is deemed to be incurred on the day the plant or machinery is capable of being used for the purpose of the business. It is also provided that where expenditure is incurred for the business that is about to be carried on, such expenditure will be deemed to be incurred when the business actually commences. Now we are going to see about the balancing allowance and balancing charge. When a person disposes of an asset, adjustments are made to arrive at either a balancing allowance or balancing charge. A disposal can come about under the following circumstances, which are when a plant or machinery is disposed of, the business permanently ceases but the plant and machinery continues to belong to the business, or the plant or machinery permanently ceases to be used in the business. Under paragraph 61, Schedule 3, a plant and machinery is disposed of, it is sold, discharged, or destroyed or it is ceases to be used for the purposes of the business. Under paragraph 37, Schedule 3, balancing charges is restricted to the actual allowance given. On 12 December 2017, the IRB issued the Public Ruling Number 7, 2017, which is Disposal of Plant or Machinery Part 1, other than controlled sales, to provide guidance on disposal of plant or machinery. It explains the different circumstances when balancing charges allowance may arise. The Public Ruling Number 1, 2018, Disposal of Plant or Machinery Part 2, Control Sales, was issued on 26 February 2018, and the objective of this public ruling is to explain the meaning of control for the company and partnership and the tax treatment on the disposal and the acquisition of an asset between two parties that are related in terms of control. First, control in relation to a company means the power of a person to conduct the affairs of the company in accordance with its sole discretion by the way of shareholding, voting power, the powers conferred by the Articles of Association or other documents relating to the company. Second, control in relation to a partnership means the right to a share of more than one half of the visible profit of the partnership.
Okay, thank you. Okay, my name is Najmana binti Ahmad Nawawi, number matrix 261106, and I will continue with my part, which is plant and machinery which is disuse, based on para 56. Okay, for the purpose of this schedule, an asset which is temporary disuse in relation to a business of a person shall be deemed to the use of the purpose of business. If it was for the use of purpose of the business immediately before the coming disuse and during the period of disuse, it is constantly maintained in readiness to be brought back to the use of the purpose. Okay, the allowance is allowed. No allowance is allowed. Sorry. Okay. Must be used in the business, obviously, and the case related is DRH 1951 FB V11. In bracket 4, a doctor claimed an allowance for wear and tear of his car but was disallowed. He is an employee and not carrying a business. So that's reason the claim is not allowed. Okay. Next. Okay, next, which is plant and machinery owned less than 2 years. Okay, where a person has incurred qualifying expenditure in relation to an asset which is owned by a person for a period is less than 2 years, except by a reason of the death of the person or any reason as a director general think appropriate. And that any allowance which is but for this paragraph, for paragraph 71, there would fall to be made for him in relation to the asset shall be made, and there where any such has been made, balancing charge in amount equal to and such allowance shall be made to him for the year assessment in the basis period for which the asset has been disposed by him. Okay, so in this based on this para 71, the allowance would not be allowed. If allowance have been claimed, a balancing charge need to be equal to the allowance claim will be charged to the claimant in the year assessment of the basis year. That means the balancing charge equal to allowance claim. Okay, next. Okay, for the last part, for capital allowance, which is a hire purchase agreements based on para 46 schedule 3. I simplify it with my own words. Where the person buy the plant and machinery under the hire purchase agreement, the person shall be taken to the owners of the plant machinery and capital expenditure incurred on the plant machinery in the basis period of the year assessment shall be taken to the capital portion of any installment payment or aggregate of those payment made such by person under the purchase agreement in the period. Okay. So the hirer is deemed to be the owner of the asset and entitled to claim allowance related to the capital portion made in the relevant period. Claim the initial allowance against the capital portion And last, interest portion excluded. Okay, that's all for me. Thank you.